both think the equity market can move higher from here. Mike, you say the equity rally is likely to continue into its 11th year. However, be prepared for a style rotation. That sounds very elegant and fun. Kenny, you say 3,600 is an achievable number in your view. But my question for you, bulls, is how do I hedge that and protect the profits that I made in 2019 and earlier? What do you say to that?
So the reason we think there's going to be a style rotation is last year, only 2 sectors outperformed the S&P 500 out of 11. Tech. Communications, which is a part of the market, and tech outperformed by 20%. Tech has gotten so big now that the top 5 stocks are almost a quarter of the total S&P 500, just in those couple of names. So you have to move out of those areas and where you can participate in the market, but actually at a much more attractive price. So we're actually looking for defensive value.
So you'd lighten technology and move into defensive value areas.
That's right. So thinking about things like utilities, real estate, consumer staples, areas with big dividend payments, high earnings, but they're trading at a lower price to equity than a price to earnings than the market as a whole right now. All
right, I'm going to stir the pot here because Mr. Polcari says, I like tech because of the 5G revolution coming and what that will mean for the whole sector.
Right. So that's true. But tech is a big space, right? It's beyond just these 5 names, which is what he's talking about. So you have to look beyond that. Tech is certainly 5G is going to change the world once again as we know it. So it's got to be a place that people should be in. There should be clearly exposure to tech. But like you said, you have to be very diligent, right? So you have to peel some off the table in stocks that have outperformed, keep the core position, and then use the cash raised by doing that to reinvest it either in other parts of the tech space and or some of the other sectors. Look, energy is another sector, which I know we can talk about it all we want. I think it's deep value. I think there's a great opportunity. You might have to wait. It just might be money you have to be patient with. But, you know.
Well, Brian knows a ton about energy and its particular issues that it faces right now. I mean, their debt issue is huge.
That's right.
And if they're not contributing to earnings growth, then you look at an earnings estimate that is going to come down 0.7%.
Okay.
Also.
Right.
And we've got this headline, which just crossed, that the tariffs may not go away, even with the deal being signed. But yet, I agree. I know what you're going to say, that there was no deal in place to reduce those tariffs anyway.
Exactly right.
But
so that's
the market reacted.
But the market reacted. Yeah, but did the market react because, in my mind, we had this conversation while we were in the green room, the market's a little bit stretched. And so, in my mind, you get any headline that appears to be a little bit negative, and you see immediately what happens. There was never a conversation about elimination of tariffs, even in phase 1. They've reduced them, but they're still keeping tariffs. And that was never going to change. He never said he was going to eliminate tariffs.
Something changed. The market lost 150 points in 12 minutes.
Okay, because it happens very quickly. It happens automatically right through the algorithms. They swing it around. But 150 points on the Dow. Look where we've come from. So this 150 point swing in the Dow is nothing for anyone to get themselves all nervous.
So the market, do you agree with what Kenny just said? And that is that the market is vulnerable, given its level of price right now, to headline risk like what we're seeing right now. That's question number 1, because I'm famous for compound questions. Question number 2 is, if there are gains this year, are they going to be front-loaded in the first half of the year, and does the second half of the year become dicier?
Look, it's all about what's in the price right now. Expectations are high. Tech is great. The best profits we've seen in a generation, but tech's up 800% since the 2009 lows. It's up 50% last year.
Right.
What's not in the price? Expectations are so high that even a slight miss in a couple of those tech companies that we all like could send the market down and create volatility.
But
and that's why we think about the style rotation.
I think, Kenny, that's why the market did react. And all your points are well taken, my friend. But here's the thing. If we are so-called price to perfection, then if we do get a speed bump in trade, if we do get a speed bump in oil and gas, if we do get a speed bump in the election, whatever that bump is, has got to slow this car down, does it not?
Well, you would think so, and we keep saying, how long have we been saying, the market starts, and every time we say the market goes up another 3-4%, right? And so I do think...
even Tom Brady retires.
Absolutely right. But I do think, to answer your question about is it all front-end loaded and what happens towards the end of the year, is is a lot's going to depend on what happens come the summertime and we start to really see who's risen to the top, who the Democratic candidate is, what that platform looks like, what sectors are then going to be affected, right? If you get someone on the far left, like Bernie or Elizabeth Warren, you got to start thinking about pharmaceuticals again. You got to start thinking about technology because they want to break them up. You got to start thinking about health care. If it's someone who's more in the center, then less so. So I think
how much of a race is this going to be, really? Between whoever the Democrat is and whoever.
Wow, that's a whole nother conversation. How long do we have?
Yeah.
But you're absolutely right. How much of a race is it going to be?
How much time do we have? You just said not long. And so,
but going back to
I guess that's a hint that we need to wrap
But going back to those expectations on what's been one of the major catalysts? The Fed last year, the year before that, tax cuts. If this is a close election, which it's going to be, it doesn't matter who the Democratic candidate's going to be. It's going to be higher taxes and higher regulation.
You can trace the entire gain of the market the last 4 months to the expansion of the Fed's balance sheet. They overlay almost perfectly.
Right.
So what happens when and if that balance sheet starts to contract?
And look, the Fed is on hold for 2020. There's only less than 200 basis points left.
I'm not talking about rates. I'm talking about balance sheet expansion. What they say is don't call QE, which we all know is QE.
Right.
Liquidity.
It started. They've jarred back liquidity in the market because they realize that because of the new Dodd-Frank regulations, there needs to be more liquidity in the market.
But that question has been a question we've been asking since they started QE a dozen years ago. Okay, we all get it. It has to be done. But what's going to happen when they really start to pull it back? Right. And we don't have the answer yet.